Labor Day, if that's the right expression. Happy Labor Day. It seems somewhat of an oxymoron, perhaps, but nonetheless, May 1st, a date celebrated around the world. Um, let's welcome back Mike Muller, head of Vitol Asia, to kick us off this morning with our week in review, our month in review. Mike, perhaps given that we haven't had you for a month, there was a lot of vibrations in the oil markets over the course of the last month and the last week even, but oil prices did maintain a steady trend and ended the month up about 8%. Your reflections on last week and the month and the trend that is ongoing higher.
Thank you, Sean. Yes, indeed. Brent last week almost touched $69 a barrel, and it covered a $4.50 range or so. So it is a very buoyant oil market. And many people are putting that in the context of buoyant commodity markets, and various advisory banks that people have airtime, have time for, have been putting out targets that are way higher. And people are still describing oil as a bit of the laggard in the complex. And one big reason for that, and I think the story of the week, is the dreadful and worsening situation in India, where the new Indian variant has been setting new records by the day. I don't know any Indian friends here in Singapore. There's a large Indian community here, not just in our office, but in society, who doesn't have family members that have either suffered from the virus, have it right now, or have lost members of their family. So it is really very prevalent. And there's a huge question mark in a country of 1.4 billion whether you can have completely accurate statistics. But passing through 400,000 cases and 3,000 deaths a day, there are some people that think the numbers could indeed be higher. And as a consequence, of course, we have various degrees of lockdown curfew across various Indian cities. And if it wasn't for the very important elections going on there, which run through until another week or so, I guess, I think we would see even more lockdowns in India. So the big question has been, what is the demand on impact for energy across the barrel? I saw in your little 10 headlines that you sent people up front that you had some comments on the LNG cargoes being turned back from India, but that's really a minor part of the picture. It's really the focus on diesel and gasoline and other mobility fuels. And the range of estimates there amongst experts vary because we haven't yet seen the full brunt, I don't think, of potential exports or backing off of crude that you would or should see if those analysts who think it's 300,000, 400,000, 500,000 barrels a day of demand loss are right. At the low end of the spectrum, some think it's 100,000 or 200,000 barrels per day. It's very hard to tell, of course, but we can only compare it to history. And if you look at mobility data, you get stuff from TomTom, you get stuff from Apple, which obviously only focuses on people who have Apple phones, which is a tiny fraction of society. And then you get some other Google mobility data. By the TomTom measure, which measures the 4 large cities in India, we're almost as bad as April 2020 for private passenger traffic in Delhi, Mumbai, I think it's Hyderabad, and Bangalore, if I'm not mistaken. So that is kind of serious, and therefore that makes the estimates of 100,000 to 200,000 barrels a day look a little on the lean side. But then again, we haven't yet seen India turning back cargoes of crude or exporting substantial cargoes of products. And you have to remember, the crude for May and June is already bought in tenders. So the crude will either pile up or have to be sold in a spot market, which is already finished trading. Yes, we're moving on to July crude now, and yet we're still only just starting the month of May. So it has to manifest itself in products exports. And those haven't yet been coming as thick and fast as some might assume. Now, India is very resilient. It doesn't close vast sections of the economy down. And a lot has been made of the interplay between local state governments and central government in Delhi on whether keep the economy running and don't go for crazy lockdowns or lockdown. And that debate hasn't yet played out. And I think we'll only have the clear picture after the elections. But that's the really big dynamic.
Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christoph, welcome back to the table. Another sort of continuing narrative through the last month and again last week is the Fed continuing to dismiss concerns around inflation, although they do seem to be, building. But nonetheless, once again in the last week, they sort of brushed it aside.
Good morning, first of all, before
Please.
I answer, correct my friend Mike Miller, just like last week, the Indian numbers, you adjusted for the population. There's, and I don't want to belittle anything what is happening in India, and everyone who is infected is one too many. But when you take the absolute official numbers, they don't add up. The official number adjusted for the population side indicate, number one, that the daily infection rate in India is lower than it is in most of European countries, including the UK and including Germany. Number two, the total infection rates are lower. Number three, the death rates are lower. Again, this is not to belittle anything, but it is just to say this is an example, where the press has picked an absolute number which sounds giant, is giant, 300,000, and then reports it all around and puts the spotlight on the wrong thing. This number doesn't justify the story. The problem in India, of course, is the lack of hospital capacity, is the lack of infrastructure, is the lack of money, is the lack of a plan, is too much bureaucracy, all of that. And that makes it so horrible. And I think just I will continue to correct this numbers game because it's the wrong spotlight to shine on India. And that explains why the lockdown measures are not as bad as they were in April last year.
Would we not acknowledge, I mean, I think on that point is that the number in India, nobody knows, but ultimately most analysis say it's at least a 3 to not 10 multiple of what is reported. It's a massive number, but nobody knows what it is.
That is correct, and that's the right way to look at it. But the way it is reported or so, I find is pretty. I mean, after 1.5 years dealing with this disease, it is just a lazy shortcut with journalists not checking. But I completely agree. It's the bad situation on the ground, and it must be an enormous unaccounted for number. That is the problem. So. But that also, the official number also, of course, explains why, the restrictions are less. So it's pretty careless of a government to act like that. And that also gets washed by the wayside by the current reporting. On the Fed, I think, yes, we have had another meeting. We had the phrase, it's a recovery, not a rebound. The background is, of course, one where one now has an interesting question coming up. COVID, 1.5 years old. Production capacity in the US and in other countries which are now coming out of the COVID disease unchanged more or less over that period, activity levels low. So now we see this rebound, we see this recovery within existing production capacity. And if capacity is reached for production, for traffic, for all sorts of things, there may be inflationary pressures. That's one big question mark. And during that recovery, there may or may not be big investment expenditures. That's another question mark. And whether there is big investment expenditures or not, that will then decide on whether these economies, including the US, translate the current recovery or rebound into long-term growth or not. The jury is still out, but that's one of the reasons why I think Biden is so adamant in supplementing the current transfer with an infrastructure program in order to generate long-term high growth rates and to avoid the trend growth rate suffering from COVID.
Mike, further just pick up on your earlier comments, ultimately India is all things massive and Japan similarly, not as in its scale of tragedy, but also from a pure pandemic point of view, gone into some different versions of lockdown. Brazil continues, I mean, 3 fairly large countries. And yet the oil price trend seems to be continuing on an upward motion. The markets took India in the last week and kind of discounted it as a major issue to derail a trend that is well anchored. Is this trend well anchored to the upward side? And these events, although tragic, are not going to sort of derail that?
Yes, indeed. I mean, there are other forces at play beyond the economies which are affected by the virus. India is one of the world's largest importers of energy, but we're seeing phenomenal pace of growth in economies that aren't afflicted by the virus right now. First and foremost, China. Now, we talk about China just about every time I'm on this show, but China is setting new high water marks in many, many regards. And whilst a lot is made of the volume of traffic pointing towards China, I think the bottom line is if you look at the combination of lower output from the US, let's not forget how much production the freeze-off took out of US production. They were meant to be trend lining at above 11 million barrels a day. And one of your reports had a link to a study saying that for the month of February, the US produced less than 10 million barrels a day. And that made a big dent in Atlantic Basin availabilities. I think it's fair to say that the industry is expecting further tightening of the surplus of crude oil that moves from one month into the next when it can't be placed, or there's a sufficient confidence in the Asian market and the appetite and in OPEC's ability to continue to control supply and demand, that people are more confident to just put those unsold surpluses from the month of June into the trading cycle in July and sail those cargoes towards China. And on the water and onshore statistics, to the extent that they're available in many places, would seem to bear out that view that the stock draw, which OPEC are seeking to accomplish, is continuing, despite the extra oil that should be backed out by India, which I said before we haven't possibly haven't seen the full brunt of yet. So yes, there are other economies which combined seem in minds of the market to be offsetting the bad news from India. And therefore the market is continuing to trend up towards that $70 level.
But yet the range is maintained, low 60s to high 60s, up and down the last number of weeks. Also, we have the last week, the news or the progress, if you like, Mike, on OPEC and OPEC plus, not OPEC plus, excuse me, the Iran agreement with the rapprochement with the US. But Iranian exports growing a little bit. The rapprochement, we had an interesting story, Saudi Arabia and Iran apparently indicating positive vibes towards each other. How big a factor is that in the oil market at this point and going forward?
Well, of course, it's one that everyone's watching, and we're seeing headlines coming out of what is now the third rounds of talks in Vienna. I was quite surprised. About 3-4 weeks ago, a lot of very respected commentators close to DC and Washington started opining that a deal should happen and that there was mutual desire to do so. And they placed the odds on a deal inside of 2021 a lot higher than I personally had expected it to be. And for the market to absorb those views, which are close to decision making, I believe, in the Biden administration, and not to see any impact on price, is quite something. Now, we've had some headlines this weekend while markets are shut, where an Iranian source has said that they think that the US are about to drop sanctions on banks and on oil, which of course is a big statement. The one that you put up on your 10 headlines there was the US one saying there's still a long way to go. That was the American side of things. So I don't expect a big bang announcement before we get into work on Monday or Tuesday, whenever we get back to work. But I do think that a lot of people in their minds are already pricing in a return to Iran.
Mike, if that headline came, and it seems now more when than if, is that bullish? Is it bearish for the market? So how do you read it from the point of view of impact?
That's what I was trying to get at. How much of it is already in the price? And I think a lot of the smart money, the sort of people that do speculate on flat price of commodities, have been reading those vibes from those commentators I mentioned before, and therefore there is an expectation that Iranian oil will be back. And furthermore, if, as we expect, unless there's a terrible twist to this virus story, as we expect the world continues to draw oil, the market will need extra supply at some point, because US production capacity has not been restored, with only 342 rigs in service for oil in North America. That's far off what America needs to go back from the normal 11 number to the 13 they were at in late 2019. And of course, there's a lot of spare capacity left in OPEC, but if managed prudently, I think there is space for oil from Iran to return, because it won't come back in one big bang. I think we've had a couple of historical precedents here where we can look back and then project forward how quickly everything would return. It is not a straightforward matter of just saying, yes, Iran is back because there's been an agreement. You need banking channels to be restored. You need the trading cycle trades 2 months forward. So even if it was happening right now today, you probably wouldn't see a huge amount of Iranian oil on the market before July, because everybody's bought enough oil for June already, right? And then, of course, you would have some movement in and out. But at the same time, another one of your 10 headlines you gave us, Iran has already been allowed by the global community to creep up their exports across the barrel, not just crude, because crude is a bit harder, but certainly in terms of blending components and fuel oil components. And that's been at levels where I've heard experts like Mr. Fesharaki, who know a fair bit about Iran, say that they're boasting they've sold everything they have. So the level of, let's just say, scrutiny and clamping down on exports of barrels that are sanctioned to most and seem to be going beyond China has already been happening, and therefore maybe the impact on products will be less severe than some people expect. And I would caution that the impact on crude won't be perhaps as large as some expect either. People are putting a number out there of 2-point-something million barrels per day. I mean, I think the market is ready for it. I think the market is pricing it in already to a certain extent. It's just a question of when the agreement takes place. Is it this month or is it after the Iranian elections with the next administration there?
Yeah, and the window you would think is closing on before election. Christoph, other big story last week and maybe last month is the sort of European recovery, Europe getting on top of the vaccine rollout, and general indications that it is sort of joining the US and China as perhaps another big pillar in the recovery. And then we had the headline on the end of last week of a double dip recession in Europe. How do you assess that recovery, the European story, and its place on the global narrative?
I mean, when you ask yourself the question, so where do we go next and what are the sort of key growth trends left by COVID? The picture which emerges is actually pretty clear. With respect to Europe, it's not too bad. I would agree with those people who say this, yes, technically was a recession, meaning 2 quarters negative growth. But for all intents and purposes, in most of Europe, the economies are fairly strong. And we have chatted about the supply gaps, which the impossibility of getting certain white goods here before. So when you look at the big picture, I think what emerges is you have this boom coming in the US, and we are in the middle of that, which is for real, which will really sort of propel them forward in 2021 and 2022, making the US the clear winner of the situation. We have China being the one who recovered first from COVID and now sort of paying the price for it because they're already over that hump. So the Chinese economy is back on a way to more or less of 6% growth, which is high compared to the rest of the world, but low compared to Chinese standards and low compared to Chinese aspirations. Plus, they still have their over-leveraging their financial sector problems to fix, which they put on hold over the last 2 years. And then you have Europe sort of coming from behind, and I'm afraid probably doing fairly well, but not being a match for the US and not joining the fast growth club, either the US or China, because they are just too fragmented. And what we are seeing now that COVID gave them the opportunity of having a joint stimulus program financed by a joint bond issue. But even that is sort of minuscule as far as the bond issue is going. And now you hear voices all over the continent, also including in Germany, saying, no, we don't want shared debt and we don't want shared obligation and shared bonds. And the progress which has been made in unifying fiscal policy, which is not just expenditures, but also raising the money, seems to be evaporating again. And moreover, you have now elections coming up in parts of Europe, which will be tainted or will be influenced by what happened with COVID. In Germany's elections in September, in every major opinion poll, there's only one big party left, and that's the Greens. It's going to be a very different.
Are we not overstating that a little? Isn't that?
I don't see people are mad because they feel that the government was not capable of dealing with the vaccination rollout, which is true, and. Even if you overstate it, I mean, then there are 2 big parties left: the Greens and the Conservatives, and that's it. The rest is fragmented, and France has elections a little bit later. Italy looks a little bit brighter. So what I'm trying to say is Europe is still a picture of a pleasant place, but not a place which is sort of full of economic dynamism.
Well, that's something new, I suppose.
So Sean, just a quick data point I saw yesterday. There was apparently week-on-week diesel demand growth 15% up on 2019. For diesel in the US. That's
week-on-week diesel demand. What does that tell you?
No.
You have to look a little. I think what you said is interesting.
No, he said year-on-year, I believe. Was it, Mike?
Okay. Versus 2019, yeah.
19, yeah.
So again, before this thing, I looked up the flight data. So where we are is still the same. We have about 8 times as many flights in the US now as we had last year, but still only about sort of 60-65% of what we had 2019. So there we see the full sort of unfolding of a recovery. In Europe, I don't see that. They didn't fall that steep, and they won't bounce back that much. Just the usual picture of being less flexible and also less volatile.
Mike, the other thing we had, I'd welcome your reflections on in the last week or so, is OPEC sticking to its forecast of 6 million barrel a day demand recovery for 21, and the forecast by Goldman Sachs of $80 oil in the third quarter. I'd welcome your thoughts on both of those.
The easy one is the $80 oil. I mean, that's a very tough one. But that's, as I mentioned earlier, that's part of the general uplifting view that Goldman Sachs have of commodities in general. I mean, copper flirting with 10,000. They're predicting that's going to go to 11, and it's true. I mean, there is a very large draw, and the whole underinvestment thesis that underpins all that, not least in oil. So maybe if we can focus on OPEC a little bit. It was always going to be the Ramadan meeting, as we said a month ago, and I think we got what we expected. I mean, I think OPEC are steady as she goes. They had a little bit of extra news to absorb in the terminal in Libya going down and losing 200,000 barrels a day. I don't think it came to as a surprise to some that the allocation of proceeds from oil exports in Libya is still not a foregone conclusion. But I think the market took that OPEC decision in their stride, and the underpinning view that you've asked me about now, whether 6 million barrels a day as a year-on-year demand growth is about right. Yes, it hinges entirely on what second half 2020 jet demand looks like. Will people fly in sufficient numbers to put extra EasyJet and Ryanair planes in the skies in Europe and their equivalents in Asia? And the only domestic segments that are huge and already operating, but not yet at quite last year's capacity, are China and the USA. So that is really the big shortfall in demand. And for us, that 6 million barrel day year on year, we all know that about 3 million was the loss 20 on 19 for jet fuel. We do need to see people flying in numbers. Now, a week back, it looked like vaccinated Singaporeans would be able to engage not only in official flight bubbles, because the bubble from Singapore to Hong Kong reopened, but possibly be given dispensation on not having to quarantine upon returning and go on business trips to places like where you're sitting, Sean, or even to the UK. Unfortunately, a couple of cases in the community in Singapore have given us the Asian syndrome, which is that you shut everything down again. So Singapore is in the process now of deep cleaning a couple of shopping malls where some people who had come into contact with community cases were yesterday, and the jitters are back. So things are still fragile because people are really worried about the extra transmissibility of this Indian variant that is causing a big fear factor still.
Let's go to the survey question and give everybody in the room a chance to have a voice, which is on the question of the price, which just threw at Mike there. The average price of Brent crude oil over the first 4 months of the year was $62.30. What will it be for the next 4 months, May to July? Closer to $60 a barrel, closer to 65, closer to 70, closer to 75. So the first 4 months, it averaged 62.30. What will it average over the next 4 months? And then we'll get the view of Christoph and Mike on the outlook for next week. So place your bets, so to speak. Christoph, week ahead, it does seem to be guided to a certain extent by holidays. China, Labor Day weekend, I think in the US, I'm not sure, now I've lost track of all the places, but nonetheless, some disruption. What will you be watching in the week ahead?
I checked what is kind of being published, and it's minuscule. It's nothing really interesting. So the ongoing negotiations around Iran, that's something which will continue, but otherwise I wouldn't expect much, which is of course always the situation when then something hits from the outside. I think longer term, the way to understand this is to say that $65 is an anchor. This is it's still a supply story. I don't think that demand will bounce back. Just follow the numbers. We are already in May. We know that the flight numbers will not be back to 2019 levels. They will stay below. We know that OPEC Plus has about 8 million spare capacity. Demand will not be strong enough to absorb that. It doesn't look like it's strong enough to get to 6, which would be the normal situation of 2 million spare capacity left in Saudi Arabia. So it will be too big to come up with all of that. But OPEC Plus seems to be they have done a terrific job. They're very firmly in control, and that's what reflected by the markets, that they continue to steer the ship. And it looks to me as if 65 or so is a number on which everybody can agree for the next few months until possibly shale wakes up in the US a little bit later. And I would expect on that front a well-managed market, and the attention then to turn on prices, and in particular on the inflation question, which is a question of huge consequence for commodities, no? Because commodities are a natural hedge for inflation. So if there are signs of inflation, you will not only get the price pressure on commodities, which we already see on copper and other things, where oil is indeed a laggard a little bit because of its particular story. It wasn't exactly a market-driven recovery. But you will also see people starting to put money into commodities to hedge against inflation, giving an additional impetus to that. And that's going to be an interesting scenario. But that's not for next week. That's a little further out.
Survey result and see where that sits, and give Mike. So the bulk of the room at 65, and those a little bit more.
The market has understood 65 is the new anchor.
65 is where everybody wants to be. Mike, does India continue to be, or is it already built into the market? What do you think are the big factors looking ahead, the week and the month, given that we won't be seeing you until a month?
I think we should never underestimate the capacity of the market to price in intelligently, right? So everyone thinks India is unfortunately set to get worse and set new case and fatality records. And that's already in people's minds and in people's expectations. So as I said a little earlier, we're not yet seeing Indian PSUs exporting the sort of volume of surplus diesel and gasoline that you might. That's likely to come. But I do think the market is very resilient also. I mean, Christoph, you mentioned that shale is on the sidelines and they might be back. I mean, in terms of getting more drilling rigs in there to reflect a $50-something WTI price down the curve, yes, absolutely. There's a lot more economic than justified by the number of rigs that have been put into operation so far. But yes, we've had the transition of a lot of those assets to people who are less price responsive, like oil majors. That said, if you look at flows out there, I think managed money is holding quite a lot of sticky length, which is arguably inflation hedge already. And that length will be in the market holding it up, because the open interests, if people aren't going to exit, creates natural short mindset all the time. And I do have some notion that a lot of hedging is going through, and it's not making a dent in the back end of the market. So you can hedge very substantial volumes of 2022 oil, and there are plenty of willing buyers out there to put that position on right now and put it into whatever money management position or fund they wish to establish. And let's not forget, a lot of the ETFs are now not in the front month anymore. They're in deferred months after the exertions of the market this time last year. So I think it's a resilient market. I think there's a bit more buoyancy out there. There's a bit more appetite to come back into the sector, even on the equity side, with all of the oil majors having put through results. And I think only ENI disappointed. The rest of them all put in results either side of $3 billion for the quarter. That's put a bit of confidence behind matters also. Therefore, I think. Do
you see anything, Mike, in the month ahead that could break us out of this range? You know, up to the high 60s, down to the low 60s. Can we break out of this? Is there something in the OPEC going to increase supply this month? That would say downward pressure on prices. Anything there that you would note that could break out of this range?
Well, it comes down to whether the intelligent investors I talked about are going to act surprised when we continue seeing stock draws. There is evidence that the market will and should start cleaning out these monthly surpluses that have been rolled into next month. The market is already in backwardation down the curve. And yes, people may continue to act surprised at the magnitude of those draws, despite the India factor. And I think Mr. Montepeque said so 2 sessions ago when he invited him as a guest speaker. The market is going to continue seeing these and might continue saying, oh gosh, wow, what a big draw. It's really happening. So I think the market remains underpinned, not buoyant, but underpinned by the fact that there is a stock draw. And it's not really been quite as heavy a stock draw in the first 4 months of the year as we had expected. And therefore, if you look at things like the economic indices, the monthly manufacturing numbers that are coming through from places like Europe and the US and China, you have to think those draws will accelerate. And people will say, well, here they are finally. And then the question is that already baked into people's views on price or not? So that, plus the inflation hedge notion, plus the general confidence in the commodities sector, I think underpins prices quite favorably here. And whether it's all in the price today or not, your audience seems to think yes, because 65 Brent is slightly below where we are right now. I think there's still upsides potential here. Yeah.
Well, upside potential, we'll have to see. And thank you, Mike, for joining us today. Really appreciate it. Great to see you. And Christoph, as always, looks lovely there that the spring is coming to your outdoors. So we're starting to we get to be jealous of you now as you go into your lovely spring and we go into our hot oven, stay indoors temperatures. But thanks everybody for joining us. We'll be here every morning through the week. All the best and have a great week. All the best. Thank you.